So, based on the fact that we're using that question, let's start by looking at our first technique. And our first technique is called payback. Now, payback, what is it? Well, it's the length of time it takes for cash inflows from trading to pay back the initial investment. Oh, I see. So we're spending 100,000 today, and we're saying, how long does it take for cash inflow into the future before we've got or recouped the 100,000 that we've already spent? So a very simple idea. Now, the first thing we have to pick up on is this idea, length of time. The answer is going to be in years and months, or years and part years probably. The other thing we have to highlight before we go any further is this. When we look at payback, we're going to stop at the point at which payback occurs. So thinking back to the example we were talking about, 100,000 outflow. As soon as we've got 100,000 inflow to cover the initial outflow, we stop. And that does mean, if you think about it, that we're not going to look at all the inflows. And if we don't look at all the inflows, we've got no measure of return. So, just a couple of important points before we go any further. So, given that that's what payback is all about, what I've got here is a little Mickey Mouse pro forma, just to make life easier for ourselves. We have an initial investment of 100,000. And what I've done here is, in my pro forma, is I've just put a periodic cash flow and a cumulative cash flow to make our lives easier. I'm sure you don't need it, of course. But we said that the net cash inflows were, well, if you just want to look back, 50, 40, 30, 25. So what have we got here? 50,000, 40,000, 30,000, and 25,000. Now, if we looked at it on a cumulative basis, cumulative inflow is 50,000 to the end of year 1, 90,000 to the end of year 2, and 120,000 to the end of year 3. So it's not difficult. What we see is that, well, by the end of year 3, we have more than paid back. By the end of year 3, we've received 120,000 in, and we only needed 100,000 for payback. So we could say that payback is something like this. It's going to be 2 full years, plus how much did we need to pay back in the third year? The difference between the 90,000 payback at the end of the second year and the 100,000 that we needed. And how much in total was paid back during the third year? Well, yes, 30,000. So what we end up with is 2 1/3 years. 2 1/3 years. Now, my question to you is that good or bad? And your lack of response is the correct one. We don't know whether it's good or bad. This is a highly subjective area. The one question I would ask you is it better to pay back sooner rather than later? And to that, it's a pretty intuitive answer. Yes, we want payback as soon as possible, don't we? The shorter the payback period, the better. So the question must be, why is it that we want a shorter rather than a longer payback period? Well, I suppose the issue is simply this. If we pay back over a short period, we could say that that payback is relatively certain. The longer we have to wait into the future for the payback to occur, the less likely that the payback will occur. Because, of course, the further we go into the future, the less certain things become. So, when we look at payback, its key consideration is one of risk. The longer the payback period, the more risky the project. The shorter the payback period, the less risky the project. What we're seeing here is that with a payback period of 2 1/3 years, if the target payback had been 3 years, we would accept the project. If, however, the target payback were 2 years, we would reject the project. So, looking at this sort of example, calculating payback is not difficult, but we have to understand why we have done it, and predominantly it is all about risk. So, whilst we are here, a few advantages. It's simple to use and easy to understand. I think we can all accept that. It assesses liquidity. Very important, that. If liquidity is critical to a company, the speed of payback is going to be very important, either in terms of ensuring that the company can pay their bills, or, if you wish, freeing up cash for future investment. It's a simple measure of risk. That's the one we were talking about before, most definitely. And it's based on cash flow. Now, we'll come back and talk about this one later on. But in simple terms, when we look at profit, we know that it is open to manipulation, whereas cash flow is cash flow. Far more difficult to manipulate the data. Right. So, to begin with, we've looked at basic payback. Now let's look at disadvantages. Well, as I said before, there's no measure of return. Because we don't look at all the cash flows, we cannot assess whether or not this project should be accepted based on return. And that's a bit of a flaw. It means that we can't really use payback in isolation. Instead, we can only use payback in addition to some other appraisal method. It does not normally consider the impact of discounted cash flow. Yeah, we didn't discount the cash flow. Maybe you don't know what that is just yet. Having said that, we'll see later on in our studies that you can do something called discounted payback. It only considers cash flow up to payback, and any cash flows beyond that point are ignored. Well, hold on a moment. That is the issue. It doesn't mean we can't get a measure of return. And of course, this means that when we look at a particular project, whether it is a relatively good or bad project in terms of overall performance, is something beyond this technique. And of course, there is no objective measure of what is an acceptable payback period. To give you an idea, when I had a proper job many years ago, payback for a piece of industrial equipment would be, well, we would normally expect less than 3 years. Something less tangible, maybe less than 2 years. And something of more infrastructural perspective, we would accept a longer payback period. So highly subjective. Okay. Now, before we leave payback, let's just look at something very simple that may arise. And I just don't want this trick to get away from you. You see, what happens if we have equal cash flows each year? What we will learn to call later on an annuity. If we have equal cash flows each year, like this example, what we can do is calculate payback far more quickly. Because all we have to do is to take the initial investment and divide through by the cash flow per annum, taking advantage of the fact that the cash flows are a constant. So if you wish, what have we got here? 60,000 is the initial investment, 25,000 is the cash flow each year. What we end up with is 2.4 years. Very simple stuff. Is that good? Well, of course we don't know unless we are given some form of target.